Good morning, everyone, and it's great to be here today. My name is Henry Cheng, and I guess I don't know any of you, so let me introduce myself a little bit. I just relocated from Hong Kong in September last year to Dallas, and over the past decades, I've been working in London, Hong Kong, Singapore, and here I am in the US. And I have to say, I have never asked to take a global research job this year because your president made my life difficult. And put it that way. And everyone was hoping I do have a crystal ball to talk about the stories, to talk about the future. I am going to try my best to tell about what matters for the global economy. But the most important part, I want to share with you what the most important elements for the real estate from the occupier point of view and from investor point of view. So hopefully I can wrap it up within 30 minutes and we will have some Q&A. To start with, let's talking about the macroeconomic situations. I think everyone was talking about, the press was talking about how negative it is for the economy, for the policies. But actually, as a foreigners, I always love to see what the President Trump is trying to achieve during his second term. There's a few good things. They also have a few negative impact for the global economies, for the US economy. If you look at the right-hand side, those are three policies on deregulating the business, talk about cutting the government expenditures, as well as more fossil fuel productions, is actually good for the economic growth. But the impact could be short, medium to the longer term. So those three things so-called good for the pro-growth policies. On the right-hand side, you can see when we are talking about lower taxes. It's good for the economy, good for you and I, our wallet. However, it's not very good for the inflations. And I have to say the tax rate here in the US is a lot higher than what I used to pay in Hong Kong. And then you can see on the lower bottom policies is about reduce the immigrations and also talking about the tariff. Those two are having some negative impact for the GDP growth as well as for the inflations. Why he is so overly concerned about the US economy and physical balance sheet. You can see here, just to give you the ideas, if you look at the trade balance of a percentage of GDP and physical deficit, you can see America's economy is healthy, but not so healthy. So you can see we are trading at 8% of the GDP in terms of the trade and physical deficit. That's why he's getting so worried about it. That's why he wants to use the tariff to offset some of the deficit. And then, as a foreigner, I am Taiwanese. For those of you who don't know who I'm coming from, actually I'm from Taiwan. And you can see when I was a student, I was thinking about America's is such an open economy. So you can see from 1996, that's the value of goods imported to the US. You can see the number is around 800 billion US dollars. But as of last year, you can see the imported goods is closer to 3 trillion. It's above 3 trillion US dollars. The growth has been quite substantial over the past 30 years. Which components, which categories the US import the most? You can see in the darker blue color, it's machineries as well as the transportation materials. So those things just on the background to understand what he's trying to achieve. Why people are reacting, the market are reacting this way. So you can see it's all about the tariff rate. I look at this chart, I think actually from 1940s onwards, we have never seen a double-digit effective tariff rate. So after Liberation Day, it shoot out the effective tariff rate for 20+%. We all know now, but now actually we are hoping the tariff is going to down to high teens. But nevertheless, it's never going to go back to what we have experiences for the past 50, 60 years on a single digit. I think the double digit of the tariff rates is going to be a new norm for all of us. So what is his original plan for the tariff? You can see, I just want to give you some context. So import is account for 16% of the US GDP, 16%. And then the consumer, we are buying goods. And only 34% of consumer we are spending on goods, but the rest of things we are spending on the services. And what went wrong? What went wrong is actually the Chinese government are playing bloody hardcore. So therefore, you can see the Chinese internal politics pressure doesn't want the Chinese government to back down. So therefore, you can see the negotiation with mainland China is on and off. As of now, it looks moving to the right directions. But I really don't know what is going to happen tomorrow from the press, because every day we get the news. And the price increases will come, and the bond market's reactions, I do believe the Chinese government or even Japanese government potentially has sold some US treasuries. So that's creating some volatility in the bond market's performance. As a result, you can see what I am seeing for the financial markets. On the left-hand side chart, we're talking about the MOVE index. It's a measure of the volatility for the bond market. On the right-hand side, for VIX index, is talking about the volatility of the stock markets. So because of that, you can see uncertainties create so much noises in the financial markets. I think most of my colleagues, probably all of you, are talking about your 401k for the past few weeks, few months, but I'm so happy because I'm so new to the US, so the damage hasn't been so much for me. Sorry for you guys. But anyways, that's what we are seeing on the back end of that. So given all of those backgrounds, this is a GDP. I put that this is a boring slide, talking about GDP growth. We all know that the GDP is going to slow down quite substantially for the global economy for 2025. We are expecting to see some gradual recovery for the global economy into 2026. For the US, here we are now, I think we are going to feel a lot weaker growth compared to the experiences we have over the past few years. So pretty much it's half of what we have experienced the growth for last year. So slowdown is definitely a new normal for us on the global economy. One thing to look out for is inflation. I think for the inflation pictures, again, everyone knows inflation is going to remain relatively sticky. But I want you to look at the trend. For 2026, 2027, you realize for most of the major markets, we are trending down. The Americas and mainland China, we are trending up. With a different reason. US is pretty much talking about because of the tariff uncertainties, inflation is trending up. But China has been through the deflation, so they're pumping the money into the system, trying to create an inflation. So beyond those two major economies, globally they are moving to the right direction. The US and China probably are together moving upward trend. But the US we need to watch out for because the tariff is going to create an impact for the inflation's future. So policy rates, we are expecting to see the central bank to cut the policy rates. I think ECB's, UK Bank of England, and all major Asian, Canadian central bank will cut the interest rate beyond the Bank of Japan. And the US are moving to that direction as well, but we are not expecting to see the Fed to cut further aggressively until we see signs of unemployment rate is going to rise. So therefore, initially, we thought we were going to see 3 cuts. But now, the current House view, we are thinking about the 2 cuts. Of course, there's a wider variation from different houses. People say no cut, but our view is we're going to see 2 cuts in 2025. But the condition is if we see the labor market start to soften. So that's all I'm going to talk about for macroeconomy, which you can read on the newspapers. Now, let's talking about the real estate. So first of all, I really want to talking about the space market, the occupier market. When we're talking about the occupier market, we cannot ignore to talk about offices. So I have to say, I'm so happy to see so many people in the conferences because a lot of people say to me, Americans just don't come to work. Everyone's working from home. But when I was in Hong Kong, when I was in London, everyone's back to work. 3 days a week, 4 days a week. And then, so nobody talk about return to work, which translate into the office leasing activities. You can see globally, going globally, you can see the office leasing is recovering. That means companies are taking on more spaces, and which is US, European market, and Asian Pacific market. in this sense, US is lagging behind. You guys are the last one to recover. But the good thing is all three regions are moving to the directions that demand is coming back. Leasing activity is going to grow another 5 to 10% in 2025. But not every office markets are performing in the same way. So this is just a US number. What we are trying to show you is what occupiers really want. So you can see in this slide, it shows you the 2010s color here, this color. So you can see this is constant on the positive territories, which means the companies, the occupiers only want to occupy the best quality buildings and the new buildings. However, if you look at those older at particular those two categories, the leasing has been negative. I have to say, I've been to New York for the past 20 years. Sometimes I went to some offices, it's what not to have in the office building. A lot of US office assets tick all the boxes. It's dated, it's no sunshine, no lights, it's high partitions, it's not a welcome environment. But on the newer buildings here, you can see that's what occupier wants. That's your worker wants. That kind of asset will attract the talent into the market. I'm so glad to see the US is moving into the directions. So flight to quality for the offices is so important. Now let's talk about industrial market. This is interesting. Everyone loves to talk about logistic and industrial market. If you look at this slide, you do see the rental growth on the global scales is reaching plateau. So the stronger growth for the industrial market probably is coming to the end. And then because I am coming from the Asia Pacific region, so you can see, we see a slowing down for the rental growth for the industrial logistics spaces. For Europeans and Americas still remain plateau. The reason we are seeing the slowing down for Asia Pacific, there's two reasons. Number one is that demand is weakening. For the fast growth of this region, this area, the demand is weakening. Number two, more supply coming to the market. Therefore, the rent is falling down. I think we are expecting to see similar pattern potentially going to happen in the US as well. So because of a tariff, so the leasing demands for those spaces has changed quite dramatically for the industrial spaces. You can see for three regions, US, Europe, and Asia Pacific, nearly a third of leasing demands are coming from 3PLs. And then one thing you should do more homework if you can. If you look at the 3PLs financial performance, most of the 3PLs financial performance pretty much on the weakening side because their margins are declining. So that's why I think the rental growth is going to remain plateau, probably even weakening because that was what we are seeing in Asia. And then because the 3PL is a major demand here, major demand here. So something to watch out for their financial performance is very important. But the good thing for the logistics spaces is we do not have a lot of supplies going forward in 2025. I think because of COVID, all the developers are building a substantial amount of logistics. And then going forward, we expect to see the leasing, the construction pipeline is going to ease quite substantially as well because the cost is higher, the leasing demand is weakening as well. So now let's talking about the retail. I think this slide, again, everyone got a story about the retail sales are growing quite substantially over the past few decades. I think the growth momentum was largely coming from the US and the East is mainland China. But now you can see going forward, the leasing demand and the retail sales is going to driving by the other animal. It's probably India. It's relatively small, but going forward, I do expect that India's retail sales growth is going to be substantial. That's why we are going to see some transformation in terms of their demand for the commercial real estate market. So how's the global retail rent performance compared to the US? The good thing is retail, nobody wants to touch retail during COVID. But now you can see more and more people want to touch about retail because the rents are bottoming out pretty much in the US, European, and Asia Pacific. three regions we are see the stronger-ish performance from the space market. But not every single retailers are performing in this way. So this one is particularly for the US per se. I only want you to look at this line, the dotted line. Anything above is better than the overall market. Anything below the dotted line is performing worse than the overall market. So you can see we are seeing the prime business district return to work, people coming to work. So therefore, the leasing demands coming through, retailers coming through. So the prime business district is outperforming the overall market. The vibrant mixed uses is also outperform the overall market. So if you are the retailers, those two locations is what you are looking for, because the rental performance is better, the supply is low, and people are looking for that spaces. So that is the fundamental of the global occupier market, to give you the backdrop. So how about the capital market investment activities? That's the first one, looking at a global capital market flow. Last year was pretty rough. We only had less than 800 billion of transactions globally. This year, initially we are hoping to see the double-digit growth for the transaction volume, but because of a tariff, because of a higher for longer 10-year treasuries, we are expecting to see the growth is going to be just around 10%. So meaning just surpass 800 billion globally. But if you look at the slide here, look at here, 800 billion, you cross over. So you can see probably we're only back to 2020 COVID year, or even 2014's transaction volumes. So we are moving to the right direction, so that's a long way to go compared to what we are used to have, before COVID situations. So whether investors are investing in a global major cities, this is the top 20 cities what we are recording and for the transaction activities on the top 20. So you can see New York, as always, #1, followed by, surprise, is Tokyo. So Tokyo, I have never seen the Tokyo rank as the top 3 for such a long time because of uncertainties, because of a cheap cost of finance, because of strong economy fundamentals. People are piling the money into Tokyo. You can see the 3rd and 4th are Los Angeles and Dallas. To my surprise, London fall into #5, because London used to be on the top 3 all the time. So on the global top 20 cities, you can see 3 from Asia, 2 from Europe, and rest of the cities are all in the US. So therefore, the US commercial real estate market is still the most important market on the global capital allocators on that front. This one is very interesting. This one shows you the cap rate for office, retail, logistic for the US, for European, for Asia Pacific. The higher the yield, the line is, the cheaper the price is. Okay, so you can see the cap rate around 3 regions because of a rising interest rate. You can see from here to they're all moving up quite substantially. So it means the real estate price has declined quite substantially over the past few years. So now, actually, more and more investors are interested into real estate globally per se. But from my point of view, when I'm looking at the pricing point of view, US become very, very attractive. If you look at this color is office. You can see office. The office cap rate for the US in average is 6.5%. It's the highest among the global peers. Therefore, return to work, fundamentals are coming back, leasing is coming back, office become very attractive. When I was talking to investors in the US and globally, people are looking at the office now. And then if you look at here, the retail spaces, again, US become very attractive as well. So therefore, that's why we see the revival of interest as it coming to the office and retail sectors in 2025. But nevertheless, you can see from the pricing point of view, US is very attractive. But we do see so much capital tracing for industrial, so cap rates start to compress again. When we are talking about real estate, we cannot ignore not to talk about the REIT markets. So again, I was looking at the global REIT market. You can see On a global scales, every single region, the REIT are trading at a severe discount to NAV. In the US, you can see it's trading average 20%. In European, it's around 20%. In Asia Pacific, it's also trending down quite substantially, particularly for Hong Kong REITs as well. The only one is trading at a premium is in the Singapore REITs, a little bit, so Singapore is highly controlled on that part. So why this is important? Because when the REIT is trading at a severe discount, potentially we are going to see more merging acquisitions and public to private strategies. So this one is aggregated number coming from US REIT trading at a discount. So you can see now we are trading on the double digit, close to 20%. You can see last time we are seeing such a discount trading is in 2020, which is leading into the wave of merger and acquisitions, public to private. So this is something I deeply believe more and more investors are looking into these spaces, particularly the US REIT market, because we are trading at a severe discount. So now let's talk about the credit. How about the credit market? How about the real estate loans? To start with, this is what CBRE is tracking about our lending momentum index. I think the lending momentum index has increased from September 2024 onwards. And you can see, we see the upward trends coming through. The recent dip is largely due to the policy from the tariff as well. So nevertheless, we see the lending momentum, commercial lending momentum has turned to the corner to be more positive on that part. However, given the higher for longer interest rate situations, the loan duration become very, very different. The line, the black color line, shows you the 10-year treasuries. And then the green color line shows you the weighted average loan life of loans. So you can see the higher 10-year treasuries here, so the average loan life is declining quite substantially. So therefore the borrowers, they say, okay, I don't want to borrow the money, you still want to lend me the money, it's good, but I don't want to have a long duration of loans because we have the cost of financing is simply too high for some of the underwritings. This is something I think every reporter would also want to talking about is loan maturities. I think over the past few years, particularly when I was sitting in Hong Kong, I said, wow, I'm waiting for the distress going to happen in the bloodbath, just like a greater financial crisis for the commercial real estate market. The reason is not, because number one, the bank balance sheet is a lot healthier than what we have used to experiences during the greater financial crisis. Number two, a lot of loan maturity has been extended or rolled over to the next year. So in 2025, you can see totally we see this amount, nearly $1 trillion of loan maturities coming through. Multifamily won't be a much of an issue. I think my biggest issue probably is going to be in the office market. I think the office market, some office market, when we are talking about turning the corner, good quality of asset, those office market will outperform. For the average stock in the wrong locations, if you had a substantial loan coming through, I think this is something we're going to see some more of willing sellers or distress might coming through, particularly on the office sectors. And that's what we expect to see. But the market-wide so-called distress is unlikely to happen. Why? It's this slide. Because over the past few years, traditionally we are getting the loans coming from the bank, from CMBS, from RMBS, and public markets. But more and more, because of such a vintage, so a lot of fund managers and private equity funds, they manage to raise capital from the private debt vehicles. So we can see that dry powder for the private credit strategies has been quite substantial. So potentially they can fill the gap for the shortage of the funding. Because the bank will lend by higher interest and also be very, very selective. This is the final slide for me. I think I still have a time, right? Okay, so there's a 4 key points I really want to highlight here. It's number one, I think the global economy is going to slowing down, but we are not going through a recession. So people talk about recession, I think exaggerated. We are not expecting to see a recession at all because the global economy is in a relatively good shape. The second one, flight to quality happening in every single asset classes. Occupier want the best quality for offices, they want the best quality for retail, and also for the logistic. And for the logistic per se, they want to be closer to the market, closer to consumers. Retailers, they want to be vibrant and then closer to CBD, which is where we work. And the offices, also similar situation as well. So flight to quality from the occupied point of view apply to all commercial asset classes. If you are the core capital, such as core funds, such as insurance companies' capital, what you should do, given the current volatilities, probably you should look at a long WALE asset. Means you got a long leases in your rent roll, so therefore it can remove your volatility. So the long WALE asset should be the target focus for the core capital. And the second one is a sell leaseback. Given the volatility in the stock market, right? So lots of companies are potentially going to sell their real estate into the core fund and lease back for the long leases. So this is something we are expecting to see happen more and more, particularly here in the US. Finally, when we are opportunistic investment, I think US is a great time to look at the opportunistic. Number one, I'm talking about distress. I think distress is probably likely to come into some dated office assets because of the low maturities. And the first one, we talk about motivated sales. What it means was what we are seeing globally, because the banks are very selective for development financing. So therefore, as a developer, as a REIT, I can't borrow the money from the bank easily. So what I'm trying to do is I'm selling down some of the assets and then at the discounted prices. And therefore, I can get a funding, I can get a money to redeploy it into that development project. So this one, we are going to see more and more coming through, given the current volatility we are seeing. We are addressing for the public to private market strategies because the REITs are trading at a severe discount, which is leading to the public to private. And final part is credit. I think, people, when we talking about real estate, we only talking about buying the asset, but actually providing the finance might give you the better returns, given the higher for longer situation. Banks are scaling back, be more selective. So the credit strategy become relatively attractive. That's all for me. Thank you very much. Do we have time for questions or early break?
10.
Okay.
Hi, a couple of things. I just wondered if your sort of provisional Q2 numbers showed any sign yet of kind of wariness from investors about the US, given all the sort of volatility in the press, and also a second question, why the weakness of London in, as you say, it's typically a sort of top 3 market, but we saw it below Dallas there.
Okay. The first question is the Q2 number for what we are seeing is quite resilient for now, and then the Q2 number is very healthy, and we are expecting to see a slowing down activities, but actually it's not. And so Q2 it should be another good quarter for us commercial real estate market. And what we are seeing now for the investment activities is more and more US pensions and US life insurance, because when you are capital allocators, put it that way, in the US, I only want to invest within the US because America's giving an excellent returns, excellent diversification benefits. But given the current situation we are in, so more and more capital allocators in the US, they are thinking about to go international. When they are going to international, they only want to go for Europe, Australia, and Japan. Within Europe, Central London is number 1. So that's what we are seeing. So given the noises we are seeing in the market, I think the European market probably going to attract more capital from the US into their region. Okay, that's one. The second one, London, the weakness of London. I think London has been through the repricing. I think the pricing hasn't been attractive enough for the investor to pull the trigger. And also, if you look at all the fundamentals, I have to say US become more attractive. But because of those uncertainties we are facing, we are expecting to see more and more international capital base going back to London again. And because of policy does cause some anxieties for the investors. That's put a pause in the US. Let's look at London as alternative allocations. Thank you.
Can you talk a little bit about India? You said that India is expected to lead in retail sales. Why is that, and what does that mean in terms of its commercial real estate market?
If you're looking at all the economy growth, all the demographic changes, I think India is a leading candidate. Okay, if you're looking at occupier solutions, it's quite fascinating. It's because I was in Hong Kong, so the major banks, if I resign in Hong Kong, all the companies say, okay, I'm going to repurpose your headcount to somewhere in Singapore or in India. So therefore, you can see the company corporates are increasing their footprint into the India as well, because India economy is so strong. But the real estate per se, when the economy is going strong, when the people are getting wealthy, it will create a demand for real estate. And for India, I have to say, the infrastructure is not there just yet compared to mainland China. But nevertheless, we do see the demand for real estate beyond Mumbai, beyond New Delhi, now moving to the Tier 3 Chennai. The Bangalore has been developed, moving to Chennai and Pune, all those Tier 3 cities. So therefore, when you are talking to investors, pretty much everyone wants to talk about India now. And then, I don't quote me on that part, we talk about ABC. ABC is anything but China. So people just don't want to touch China, but actually China becomes very attractive in pricing, but everyone wants to talk about India. That's a drastic differences for the two biggest emerging economies.
You mentioned that you don't think that tariffs are going to be below double digits, that they're going to be a new norm for all of us. I think a lot of Americans were expecting tariffs maybe from China, you just mentioned. How much have these global tariffs or this expansion on tariff areas rocked your world and others who work in your field and look at this from a global perspective?
Well, this is a tough one. And because we cannot forecast humans' behavior. And what we are seeing is a lot of people try to diversify their supply chain. For example, if we talk about Mexico, we talk about Canada, because under the trade agreement, quite a lot of services are coming from Mexico, Canada, they're exempt. And so therefore, when we are talking to those occupiers, they pretty much want to diversify the supply chain. The number one, what we are seeing now is a lot of manufacturing, they are moving out of China. They are moving out of China not because of this turn, it's because of the last turn. They are diversified into Southeast Asia. They are diversified into reshoring into Japan, they go to Mexico, but given the tariff, those companies are coming into the US as well. And then because a lot of manufacturing coming from Asia, surprisingly, they are also coming into southern part of the US, like the Sun Belt states. The Texas seems to be a winner for them as well. But the number one strategy, what we are seeing from the occupiers, is pretty much try to diversify their supply chains. I have to say people overly focus on the negative side, but I have to say for the immigration stuff, in any normal probably countries, probably we always are very focused on immigrations. If you're the proper one, you can stay here, work here. I think Australia did a fantastic good job. They opened the labor markets based on what they need for the economy, so people can come to Australia without any problem. Okay, so I think that is a good thing. And but the problem is when we are in a lower demographic growth. America is very open for immigrants to come here to work, and so therefore give it an image for the global community, particularly in the newswire in Europe and in Asia, it's quite challenging. And so therefore all of the investment and they are wait and see mode, particularly for those major institutional investors. However, there's a big however, we do see some family offices, particularly they have a stronger tie with the US. They are coming back to the US. They say, come on, US is so cheap. As of now, the discount is quite substantial. So therefore, I'm coming to the bargain hunt as well. So we do see some different opinions. For institutional investors, they'll be more cautious. For the family private money, they are looking for the bargain. They will come in to buy real estate.
So, we hear a lot about, the negotiations of trade deal with China and the US, but we don't hear a lot about what the trade terms are that China wants. Do you think you could elucidate what those are? I mean, what they might agree to?
It's really, I wish I had a crystal ball, it's quite hard. But I think because I'm coming back from, and I was in Hong Kong, and 2 weeks ago, even in Hong Kong, it became nationalism. So therefore, they said, if the US is going to harm us, we're going to harm them. So for China, Chinese people, Chinese government, they feel they can get poor. Doesn't really matter. But Americans, they use the luxury life, they don't want to back down. So there's internal political pressure for the Chinese leadership is very, very strong. And when I was reading some of the press in Hong Kong, you can see that the tariff imposed into China, the tariff rate is pretty much consistent with what Biden was proposing 4 years ago. So therefore, there's no additional higher, no additional lower. So therefore, they say it's all about press and medias. But they say if you look at the slice and dice, actually the impact is less than what we are reading from the public information. Again, I'm not a trade expert, but that's what I'm seeing on the newspaper in that part of the world. Okay, we are run out of time, so we're happy to take the question outside later. Thank you very much, everyone. Thank you.